Hello and welcome back to Game of Trades, your #1 channel for videos on the stock market and cryptocurrencies. This video is going to be focused on the S&P 500 that just continues relentlessly to drop like a stone. This looks like a very scary chart right here. I think few people saw this correction coming to this extent. Now, when we were talking about a correction back in December 2021, January 2022, right after the Federal Reserve announced that it was beginning to hike rates, they announced that back in November. We took a look at previous tightening cycles in history, and we saw the fact that initially in a tightening cycle, you can get a little bit of volatility when that tightening initially starts, right? As the market kind of reprices the valuations based on the fact that liquidity is going to be tighter from now on. And these are some of the examples that we took a look at: 1994, 2004, 2015. And so we were looking at that, and we saw that the average drawdown in these corrections was around 10%. So in 1994 it was 10%, in 2004 it was around 9%, and in 2015 it went all the way down to 15%, right? And that's really what led us to put 4,200 points as our maximum drawdown for this correction. Now, obviously, since that all-time high back in January, what have we had? We've had significant economic weakness, and we saw the yield curve just absolutely plummet right here between January and April, even leading to a yield curve inversion right here, right? So a recessionary signal. So what was initially a early cycle correction, like these examples that I just talked about, it actually turned into a late cycle correction, where the market is concerned about growth slowing. And so it begins to wait and see if there's going to be some monetary easing that's going to come in the near future. And that's really the signal that the market is waiting for. And so that looks a lot more like the correction that we had, for example, in 2018 here and in 2006. So it's kind of a weird combination of both an early tightening cycle and a late tightening cycle where the market is waiting for that sign of monetary easing. Now, what we're going to talk about in this video is whether the fact that 4,200 points was broken, that max drawdown target that we initially had, whether that changes everything about what we should expect in the near future, and answer that simple question that I just asked. You know, if the market is waiting for liquidity, if it's waiting for some sign that monetary conditions are going to become easier, can we actually reasonably expect that in the near future? That's exactly what we're going to talk about in this video. If you're interested in following these crazy markets with us, make sure to smash that subscribe button. Do not forget to click on that like button if you enjoyed this episode. Now, without further ado, let's get right into it. So let me just show you what I mean when I say that the market is waiting for liquidity. Now, first of all, before we answer that question, let me just put this into context, right? This is the NASDAQ 100 stocks above their 200-day moving average. And you can see where we are right now. We have less than 15% of stocks in the NASDAQ 100 that are trading above their 200-day moving average. This is the breadth of the NASDAQ. Let me put this on a line chart. Hopefully you'll see this more clearly. This is really where you start to get to capitulation type of levels, right? You rarely see these types of corrections, and eventually it leads to a significant bounce, a significant recovery. Sometimes it's just a bull trap, right? For example, back in 2008, the market went from overbought to oversold very quickly. Then it bounced, and then it eventually crashed again. Market went from overbought to oversold. We haven't seen a real multi-week, multi-month bounce yet. So we are really getting towards those capitulation type of levels on the NASDAQ 100. And if you want to see what that means, when I add the S&P 500 on this chart, this was the bull trap of 2008. It was still a multi-month rally here during March, April, and May of 2008. And then, of course, it triggered these massive, massive bottoms throughout the bull run in 2011, 2016, 2018, 2020. So we are at comparable levels to all of these corrections, which all happen to be significant buying opportunities looking out 2-3 months, and of course 6 to 12 months if you exclude this reading right here. Now, if we go back to that candle chart here, could we see a little bit more downside intra-week? That's possible, right? Look at these quick capitulation type of moves. Considering the technical structures we've broken down, it wouldn't be impossible to see this type of capitulation before we see any type of real bounce in the market. Now, back to that question that we were asking at the beginning of the video. The market is waiting for some sign here, some sign that we are going to get easier monetary conditions, right? You had a very similar type of setup back here in 2018. The market just tanked over and over again until you had evidence that you had some type of easing financial conditions. Now, let me quickly show you a chart, and I think you're gonna like this. This is the 10-year yield right here, going back to 1960, so that we can get this inflationary cycle of the 70s, right? Because people often criticize that a lot of my charts only go back 20 years. It doesn't take into account higher inflation periods. So let's go back to the 70s and see how yields behaved with the stock market. Let me zoom in to this period here. Systematically, tops and yields coincide with bottoms in the stock market. Top and yields, bottom in the stock market. Top and yields, bottom in the stock market. This was also the case in 1994 here, right? Top in yields ended this multi-year correction in the stock market. Now you can see what really has been driving this correction throughout the past few months. The market has been going down because of an absolute carnage in the bond market, right? Look at these bond yields. The 10-year yield since December 2021, right here at the top of the market, yields have been spiking like they have never before, right? We haven't seen this since the 70s. So the market, in the meantime, is tanking, waiting for that move to stop, waiting for evidence that this move is going to stop. And once it does, if it does, that's when you get that big, powerful recovery on the NASDAQ. And then, of course, we'll have to take a look at how strong that recovery is to see if we can get back to the all-time high. I know this is a contrarian outlook, but I still think there's a very reasonable chance we jump back up to the all-time high. There is still a ridiculous amount of money in the system, right? And I think a lot of people underestimate that. This is a chart showing you money market funds' total assets, right? A total amount of basically cash that exists. You can see there's still a huge amount of cash. This is not comparable to the levels that we had back in 2007. So there is a huge amount of money here to buy the dip and fuel a nice run. Now, if we take a look at what's happening on yields over the past few trading sessions, we are starting to see signs that perhaps they're cooling off a little bit. This is probably the biggest correction in yields we've had since February 2022. We have what looks like some type of a topping pattern, and we've had a head and shoulder here pattern that should take us a little bit lower. But most importantly, what I wanted to show you guys is the 5-year break-even inflation rate. That's been just dropping like a stone here over the month of May. This has been really a great leading indicator of inflation from the beginning. This is part of the reason why we were so vocal about rising inflation back in 2021, because the 5-year break-even inflation rate was breaking out massively. If we take a look at the inflation on top of this chart, you can see it's a pretty good indicator, right? It showed inflation breaking out right here throughout the months of March, April, between around April 2020 and February 2021, it showed inflation was set to break out before it broke out, right? And then the big inflation breakout actually happened on the CPI prints. Now we're seeing this break-even inflation rate look like it might be slowing down. And if we take a look at where the 10-year yield is from a technical standpoint long term, we do have this final trendline resistance here that's got a lot of very significant reactions. So it is a point of supply where investors are going to start stepping in to buy bonds at an attractive yield, right? And it does seem to have reacted off this trend line already, right? Perfectly. So that's a promising development. And that's on top of the fact that we have the RSI on this monthly chart of yields showing us we've never been this overextended before. And systematically over the past 20 years, systematically overbought readings on the monthly chart have coincided with these big tops that I've highlighted also on this trendline resistance. And of course, the same thing applies to Treasury bond prices, right? This is the TLT ETF. This is from an article that we posted on gameoftrades.net. It also shows historical amounts of overextension relative to the 50-week moving average, right? It just, you'd never get this type of correction. You did have that in the 70s, but even during the 70s, it triggered bottoms in the bond market. So that's why we added Treasury bonds to our trading watch list. I think they make for an excellent diversified trade in a portfolio right now. And I think it's a very contrarian trade, which is what I like about it. There's a huge amount of bearish sentiment around Treasury bonds. And so people are actually capitulating out of TLT. They're selling their Treasury bonds instead of accumulating right as we get that peak inflation, right as we get those recessionary signals, which can protect your portfolio against deflationary risks. And that's a big objective that we have here. We're very well aware of the different types of macro risks that exists. There's inflationary risks, but there's also deflationary risk. We've got an over-leveraged economy, over-leveraged financial assets. We've got extremely low consumer sentiment with money supply growth that's practically negative. These are deflationary risks, and bonds are protection against that. That's why we'll be covering them very closely over the next few months and watching out for opportunities, entries, exits, and what our expectations are in TLT. It's pretty incredible that we can actually share this information with you guys. It took us a long time to figure out how to play the market, how to play these contrarian trades, what indicators to watch. You know, that is really the mission at Game of Trades, is to help you find those underpriced assets, those contrarian trades, and give you an edge on the market. And we do that through the trading watch list where we have a variety of different trades. I am going to be updating all of them this week. We obviously have the ratings dashboard that gives you our current convictions, whether that's short, intermediate, or longer term, across different sectors, across all the assets that we like to look at, and of course, all the reasons behind those convictions. So if you're interested in having access to this research, make sure to click on the link down below and go to gameoftrades.net. So if the stock market is really waiting for a signal that the bond market is going to reverse and that we're no longer going to get this uncontrollable rise in yields, I think we're going to get that soon. And that setup combined with this chart here that shows us that one of the most important sectors of the SP 500, the tech sector, is really near extreme oversold readings. You know, that's a pretty good setup for me. We've been advocates for a bottom since 4,200 points. So obviously this correction has gone than what we anticipated. If we really do need to paint a worst case scenario for this correction, we do have this head and shoulder that's clearly broken down now. Playing out that head and shoulder pattern, that takes us down to 4,700 points, where we do have quite a bit of technical support here. We also have quite a bit of support at the 38.2 retracement level, which sits at around 3,800 points. I think the takeaway here is that the stock market is waiting for the bond market to cool down. Once it gets that signal, you're going to see the market recover very nicely. Based on the indicators that we're watching, it seems like it could be any day now. Now, again, if we're wrong or something very unexpected happens, like an escalation of the war in Ukraine, and you see another commodity spike, another inflation spike, and another spike in yields, that would create panic. That would not be good. All right. Now that's about all I wanted to cover in this episode. I hope you guys enjoyed. If you did, make sure to drop a like and subscribe to the channel if you haven't already. Now, in the meantime, I wish you good luck on your trading and see you next time.